Welcome back, finance enthusiasts. Today, we're diving into one of the most dramatic stories in the history of Wall Street, When Genius Failed by Roger Lowenstein. This book tells the incredible rise and fall of long-term capital management, a hedge fund that seemed invincible until it brought the financial system to its knees. If you're looking for lessons in personal finance, risk management, and the dangers of overconfidence, this story has it all. Stick around to find out how the smartest guys in the room made the biggest mistakes and what we can learn to avoid similar pitfalls. Our journey begins in 1994 with the founding of Long-Term Capital Management, or LTCM, by John Meriwether, a former bond trader at Salomon Brothers. Meriwether assembled a dream team of financial experts, including 2 Nobel Prize-winning economists, Myron Scholes and Robert Merton. With such impressive credentials, LTCM was quickly regarded as a powerhouse in the investment world. Their strategy was based on complex mathematical models and sophisticated trading techniques designed to exploit market inefficiencies. LTCM's early success was nothing short of spectacular. They generated annual returns of over 40% and attracted billions of dollars from investors eager to cash in on their genius. The firm's approach relied heavily on leverage, borrowing large sums of money to amplify their returns. This aggressive strategy worked well in a stable market, but left them vulnerable to unexpected events. For our personal finance audience, the key lesson here is the danger of over-leverage. Borrowing money to invest can amplify gains, but it also increases risk. If the market moves against you, the losses can be devastating. It's crucial to understand your risk tolerance and avoid taking on more debt than you can handle. The first cracks in LTCM's armor appeared in 1998. The firm had placed massive bets on the stability of global markets, assuming that historical trends would continue. However, the Asian financial crisis and the Russian debt default caused market conditions to change rapidly. Suddenly, LTCM found itself on the wrong side of several large trades, and their highly leveraged positions began to unravel. As the losses mounted, LTCM's brilliant minds struggled to adapt. Their models, which had worked so well in the past, were now failing them. This highlights another important lesson for us: the importance of flexibility and adaptability in financial planning. Rigidly sticking to a strategy, even when it's no longer working, can lead to disaster. It's essential to regularly review and adjust your financial plans based on changing circumstances. LTCM's downfall reached its climax in September 1998. As their losses approached $4 billion, the firm was on the brink of collapse. Given the size of their positions and their connections with major financial institutions, a failure of LTCM threatened the stability of the entire financial system. The Federal Reserve stepped in to coordinate a bailout, convincing several major banks to inject $3.6 billion into the firm to prevent a broader crisis. The LTCM saga is a stark reminder of the systemic risks that can arise from interconnected financial markets. For individual investors, it underscores the importance of diversification. Putting all your eggs in one basket, especially a highly leveraged one, can have catastrophic consequences. Spreading your investments across different asset classes and regions can help mitigate risk and protect your portfolio from unexpected shocks. Another crucial takeaway from When Genius Failed is the danger of overconfidence. The principals at LTCM were some of the smartest and most successful people in finance. Their success led them to believe that they could accurately predict market movements and manage any risks. However, their hubris blinded them to the possibility of failure and led them to take excessive risks. In our personal finance journey, it's important to stay humble and recognize the limits of our knowledge and abilities. Overconfidence can lead to poor decision-making and excessive risk-taking. Always be prepared for the possibility that things might not go as planned and have a contingency plan in place. So, how can we apply the lessons from LTCM's rise and fall to our own financial lives? Here are some key principles to keep in mind. 1. Avoid over-leverage. Borrowing to invest can magnify gains, but it also increases risk. Be cautious about taking on debt and ensure you can manage your obligations even if the market turns against you. 2. Diversify your investments. Spread your investments across different asset classes and regions to reduce risk. Diversification can help protect your portfolio from unexpected market events. 3. Stay flexible and adaptable. Regularly review and adjust your financial plans based on changing circumstances. Be willing to change your strategy if it's no longer working. 4. Recognize the limits of your knowledge. Stay humble and acknowledge that you can't predict the future with certainty. Avoid overconfidence and be prepared for the possibility of failure. 5. Have a contingency plan. Always have a backup plan in case things don't go as expected. This could include having an emergency fund, diversifying your income sources, or having a plan for reducing expenses if needed. In conclusion, When Genius Failed by Roger Lowenstein is a fascinating and cautionary tale of the dangers of overconfidence, excessive risk-taking, and the importance of flexibility in finance. By learning from the mistakes of LTCM, we can make smarter decisions and build a more resilient financial future. Thank you for joining us on this journey through When Genius Failed. If you found this summary insightful and helpful for your personal finance journey, please hit the subscribe button and like this video. Your support helps us bring more valuable content to you. Until next time, stay informed, stay humble, and keep striving for financial success.